Robbie here with Legacy Financial Group. Well, you might be a little surprised to get a video from me, but I just wanted to reach out to each of you, as I won't have time to see all of you before the holidays begin and we all kind of go our special separate ways. But I just wanted to share some things with you about the market and the changes that we're having and some of our new money managers that we're going to talk about here shortly. So I'm going to move out of the way and I'll just let you look at some slides that I prepared. So if we're zoomed in there, I'll go ahead and begin. If you were to take the top 8 different stock market indexes and if you were to divide them by 8, you would get about a 5.15% return. So it just gives you some perspective. If you add the Dow Jones, the S&P, the NASDAQ, Russell 2000, all of them together, you get quite a variety of returns. The S&P have done pretty well this year, but looking at it on the average, just to give you some perspective, here's the next one here, just showing the S&P 500, emerging markets, large cap, international stocks, mid caps, Russell 2000 stocks, even the Chinese, just to give you an idea, showing you that once again that kind of the average return there is around the 5% level. Here, and the 60% and 40%, 60% stock and 40% bond sort of mixed portfolio is kind of a average mainstream portfolio. So I'll use that as an example. So if you used a couple of different sectors, ACWI and iGov, which would be an enormously large stock sector and bond sector, you get an average of about 2.88%. Now, if you took Wedco Power Dividend, one of our money managers have averaged so far this year about 14 to 15% so far the gains. That's a guesstimate. And yet Redwood Management has struggled in that bonds have been flat, but if you go with the diversification model, you see you get about 8%. So I really think in the future that we need to talk about having kind of a broader, for those that are willing, a diversification model for next year. And I would like to visit with as many of you as possible and make some changes and have some annual review. But I wanted just to make some comments about the fact that bonds have been flat this year. You know, actually the bond market is made up of about 15 to 20% in the oil industry. And so I know everybody's been enjoying the low gas prices. When you go in and fill your car up, you can do it for a whole lot less. But that's affected the high yield bond market greatly. And so Redwood using bonds have been flat, and that's why, of course, we moved many of you over to the Redwood Smart. But key factors, slowing demand from Europe and China, the strengthening of the US dollar, increasing global supply. They're producing and insisting on producing more than the actual need is. So that's driving the prices down lower and lower. And eventually, as we've always seen, that will come back. But that's some of the factors involved in the lower oil prices and how it's affected the bond market. And here, just showing one of the popular Vanguard accounts, an energy account, how it's lost over 25–30% since last June. So I just wanted all of you to remember that, our management style, it's a long-term marathon. It's not a sprint. We're not day trading here. We're looking at the long term, 3 to 5 years. We're the tortoise and not the hare. Our goal over 5 years and 10 years is to average at least a 5 to 7% per year, but of course we can do much better than that. But as I've already mentioned, Wedco Power Dividend has already had 14 to 15% gain this year. So we can make some changes so long as I know that it still fits the risk model that really fits your style, your comfort level. And the only way to do that is just sit face to face and kind of reevaluate where we are. And I'd love to do that for all of you if you'd like to do that. Just to give us more perspective, here's the 15-year annualized return for the S&P 500. And you can see it's only averaged 2.71%. That may be surprising to some of you. But what we don't want is in retirement to have those low type returns over the long term. We've got to do better than inflation. And so if I included a chart from what's called the Dalbar study, and that's a chart done by an independent organization showing, and I'm just going to point to one thing on here, a 10-year return for the S&P 500 in this case is 7.1%, but the asset allocation fund model for most investor returns was only 2.38. Well, why is that? Well, it's because you have the problem of people getting in and out of the market at the wrong time, and they come in, when the market's at its all-time high, and they get out when the market tanks. So we've got to, and one of you that wants this study, it's like 25 pages. Aubrey can send that to you. Just email her, Aubrey Wellborn at windstream.net, and she can send you a copy of this Dalbar study. And if you read it and kind of comprehend it, you'll be smarter than 99% of all the investors in the United States as far as on the psychological level. But we want to avoid those kind of pitfalls. We don't want to do this. Here's one of the most popular funds with Fidelity Contra Fund, and of course in 2008 lost 50%. How would you feel if you lost 50% of your money? I would feel horrible, and so we want to avoid those kind of pitfalls. We want to avoid getting enamored with individual stocks. Here we have a General Electric company. We just remind ourselves how it went down 84% in a short period of time. So we got to be careful to avoid those kind of pitfalls as well. But now we have some exciting news from Horder Investment Management, and we're actually bringing on 4 to 6 new money managers. It's going to be approximately 4 of the low risk, low volatile type money managers, similar to Redwood, and then also 2 of the moderate risk type managers. So of the low risk, we have income portfolio type management companies. We're going to introduce a government bond portfolio type management company and a municipal bond portfolio. And so we're going to include that. Of course, we're going to be very careful about the cities that we allow into our portfolio. I wish they were all Texas cities. Texas is one of the strongest states in the United States in growth. So, and then our moderate risk, we're going to have a stock over the counter and where we can make money if the market goes up or the market goes down. We're going to be using NASDAQ, S&P 500, where we can make money if the market goes up and go down. We're going to have managed equity sectors. We're going to even have sort of what's called a sleeve, a blend that's optional, that would be a blend of government bonds, income portfolio, and equity managers. So all based upon your goals and your risk tolerance. So, first part of next year, which is just around the corner, I would like to beat as many of you as possible, but take in consideration that these new money manager accounts won't be finalized and approved. They're in the final stages of approval till about January the 15th. So keep in mind that after that point, when they're available, I'll give you all the details and we'll make some changes. We certainly want our clients not to go backwards, but we also want you to do very well and average that 6, 7, 8, 9% type levels, and we're going to keep our average up in that regard. So I do want to just finalize and say that, you know, our existing money managers, we still think very highly of them. Of course, we're keeping them, but and they're at the top. There is the new Redwood Smart in purple, and we have Wetco Power Dividend here in the light blue, and that's well ahead of the S&P 500, which is in black. And our other money managers, even though their bonds would still beat the S&P 500 in the long term, but bonds may continue to be flat, and we want to introduce these new money managers. So I'm just going to come back on the screen here and just say in finality that we're excited about the changes and the new money managers, and I just wanted to share you a tidbit about that. And I want you to be excited too about the future through Legacy Financial Group. And I want to again wish all of you a happy holiday, and I look forward to seeing you. Call us anytime, but look forward to seeing you just as soon as you'd like. Bye-bye.